Good morning and welcome once again to Digital Look TV. With us today is Bill Hubard. He is Chief Economist at Markets.com. Bill, good morning.
Good morning.
Thank you very much for joining us again. We do appreciate it. Okay, the Fed. Mr. Bernanke seems to have ripped up the script, which everybody had for the markets in the next couple of months. What happened?
Well, I don't know. I mean, I think my feeling is, has he miscommunicated, or did we only hear what we wanted to hear? Because, I mean, we go back to the 22nd of May, and everybody was talking about, well, we're going to get tapering. Then it went from tapering to September to tapering, and then tapering light. And then last night, I mean, I think the consensus on Bloomberg was plus 10 billion and a dovish statement. Exactly. I think there were probably only one or two people that had said, well, we don't think there'll be any tapering. And I mean, I talked to several people yesterday, and they said, yeah, tonight we'll get 10 billion in treasuries, then we'll get a very dovish statement. And then the next question is, what do we do the rest of the year? Well, as we saw last night, I mean, we had a year's worth of equity movements, a year's worth of gold movements, selling of the dollar, a year's worth of bond movements in 2 hours after the Federal Reserve. And we're seeing the continuation. First in Asia, we had a 4-month high in most of the Asian stock indices, and I think the DAX reached an all-time high this morning.
Indeed. So there's a lot of investors out there in a world of pain at the moment. However, in the end, we're a bit more optimistic as far as risk appetite is concerned, looking out towards year-end in 2014, that's correct?
Yes, I think so. And I mean, as Mr. Bernanke said last night in the press conference, again, only implying that rates will be no higher than probably 0.5%. Maybe that's only 25 basis points in 2015, and maybe only another 1% added to that in 2016, which is basically what the market should have been inferring. But yet, conversely, here in the UK, the Bank of England keeps trying to tell us it's going to be late 2016 before rates go up, except for a slight problem in UK retail sales this morning. The market here in the UK is talking about interest rates going up in the second quarter of 2015. Hence the reason we'd started to see them move up in sterling. And sterling, of course, soared above 160, 161 last night. I mean, it's come off a little this morning because of UK retail sales. Excuse me, but the euro at 135, sterling at 162, 163, it's going to be the death knell for any type of trade problems.
Okay. Can I ask you to perhaps, I know this is extremely, if not impossible to ask of somebody, but to venture a forecast for cable looking out towards year end?
Well, excuse me, I mean, I think people were already talking like 163 plus. Now, we went through 157.50, 159, 160, 161, 162. Now, again, it's going to be a situation where if we may reach the point, I don't know whether we've reached it today with a sobering effect from UK retail sales, but the simple fact is we've got another meeting in 2 weeks with the Bank of England. If no change in rates, will they make a statement? Because it's really a situation where if they still feel that 2016 is the right level, then 163 is not the right level for sterling, okay? Sterling should be at least through 160 and probably even lower. And as I mentioned earlier, sterling at this level will not help it, or it will be totally detrimental to the trade balance.
Could it force the MPC's hand at a given moment down the road if it keeps going up like this?
It's not supposed to, but it is the spectrum of looking at how the economy acts or reacts, okay? I don't know whether it's 160, 163, 162, does that mean we lose jobs to some other parts of the world, et cetera? I don't know. But the bank has to look at the impact. And I mean, we've seen this in the States over the last umpteen years, because every one of these G5, 10, 15, 20, G whatever meetings, it's always, well, we must discuss with the United States because are they involved in a currency war? Are they deliberately keeping the currency low? Because if U.S. consumers not buying, let's make sure that Boeing, Ford, et cetera, is selling their products cheaply overseas.
Okay. Going back a little bit to the Fed, but also related to the Bank of England. Certainly yesterday, the Fed, there's a lot of focus now on central banks' communications policies. There was a poll recently from Barclays Research. The Fed came out best from that poll. Investors said that it had the best communications policy. It would be interesting to see what the results of that same poll would say this morning.
Well, I think one of the things that, again, looking at the Fed from afar, as we do, because we're not there. But I mean, one of the things where the market should have looked through at this, and again, they were still expecting some type of tapering Excuse me, I think the reason being is that on the 31st of January of next year, Mr. Bernanke term expires, whether he decides to roll it over or not. So the fact is, we know we were only looking at, even if they'd started last night, only a 4.5 month window of opportunity. The next meeting is not till December. Then we've got Christmas. Then we've got the new year, okay? So it wasn't giving, if it's going to be a new Fed chairperson, it wasn't giving him or her an opportunity to get involved. But to go back to what you said, we should have looked through the unemployment numbers. Yes, unemployment in the last 2 months had dropped from 7.4 to 7.1. One of the things you've got to look at is the participation rate, the U6. This was Greenspan's most important. We've had 347,000 fewer jobs in the last 2 months. Also, the simple fact is the OAPs, people like myself, had decided we're not going to stack shelves anymore at Tesco's. So we're going out of the workforce. Also, another thing to look at, 20.2% of American families are on food stamps.
And that's the largest number you told me before
In
since?
history, okay?
In history.
This, on a percentage basis, this is much larger than it ever was post the Great Crash and the Great Depression, okay? So, again, we would not have seen this data unless we looked through. But the Fed, and even last week when we got the Beige Book, it said modest to moderate growth. Now, again, the markets always get ahead of themselves, right? Either buying too much or selling too much, okay? So the simple fact is, it was there. And then, just very briefly, back in, I don't know, the mid-'80s or something, when Greenspan was chairman, and he was at the Humphrey Hawkins, and one of the senators asked him a question, and Mr. Greenspan's response was, if you understood what I said, you weren't listening. So, we talk about Fed speak, Bank of England speak, ECB speak. And another thing that maybe make it difficult for some of our foreign viewers is, yes, the Federal Reserve, but there are 12 Federal Reserve districts. In the old days when interest rates were adjusted, you have the repo rate, that's the national rate. But each Fed district then could adjust what they call their discount rate to help businesses improve this, that, or the other. I mean, the classic was the dot-com boom of '98. I mean, San Francisco was raising the discount rate as much as possible to stop the dot-com boom, okay? Where Cleveland or Detroit was probably having the rate, 2,000% below zero to try to get Cleveland and Detroit going. So
You think some regional banks might now be moving those discount rates?
Yes, they are, okay?
Definitely. Okay.
And I mean, what you need to do is not so much what the Fed says, but before each meeting, we get the Beige Book. And the Beige Book is always produced by a Fed district. And they talk to other districts. And hence the reason what you need to look at is like the Empire State Manufacturing. What's the employment picture? What about the Dallas Fed? This gives you, again, a perfect picture of what's happening in the specific districts, okay? What's the employment look like? What's business look like, okay? And I think, and then of course, that's always sort of combined in the ISM. So that will give you a very good real picture of what's happening in the real economy in the U.S.
An X-ray, if you will, of the U.S. economy.
Exactly.
Okay. One last thing, if you allow me.
Sure.
Miners. You seem to be positive on them.
Well, I think there's the possibility. Now, maybe that's gone out the window because, as we all know, I think Goldman Sachs was talking gold at, $1,100 an ounce, and everybody was going, well, there's got to be a point, I don't know what that point is, where all of a sudden, whether it be gold, whether it be silver, platinum, palladium, that all of a sudden it becomes profitable to start mining again. Now, I mean, I think gold's up, $72 since this time yesterday. So maybe it's not profitable anymore. But I mean, I think that's one of the things where if people now are starting to look at the potential of undervalued. I mean, we saw Boeing, okay, on Tuesday, okay, all-time high, up 65% of the year. Now, do you continue to buy Boeing, or do you buy Barrick Gold, or do you buy, I don't know, Fresnillo, or some of these companies that led the FTSE for 7 or 8 years? So, I mean, if you're looking for probably undervalued, now they may stay continue to be undervalued, especially, but the simple fact is, if the Fed has told us that interest rates will be lower for longer, if the Bank of England continues to tell us, but the market doesn't believe it, especially after the minutes yesterday, we'll see what kind of adjustment we have, because I think the last I looked, cable was off 50 or 60 pips this morning after the, so everybody said, maybe we better start listening to Mr. Carney.
And it's quite oversold as well.
Yes.
Or overbought, sorry.
Yes. And I guess last night, unless if you were long the dollar and you were a Chelsea football fan, everybody else, it was a good night.
Okay. And then with that, Bill, thank you very much
Thank
again for
you.
your time. Okay, unfortunately, we have to wrap it up here, but thank you for joining us once again. And until next week, that's all for today from Digital Look TV in London. Goodbye.